This rally sustained. I mean, India, the Sensex keeps testing new record highs.
Good morning. Yes, India has been doing well. It's amongst the best performing markets for the calendar year to date. And what is helping us clearly is liquidity plus low interest rates and very upbeat sentiments in the economy. Last 3 months, we have seen every data point on the macro front improving. All the high frequency indicators which are coming in the last 45 days are pointing upwards. The corporate commentaries at our recently held annual investment conference was great, to say the least. I mean, every sector spoke about better than expected recovery from the second lockdown that we saw in April and May. And the early results which have come in from the IT sector in the last 2 or 3 days, and yesterday we had 3 big bang results, all of them have been better than expectations, barring a slight miss on TCS. So, variety of factors, macro, micro, corporate commentaries, high frequency indicators, recovery from second wave, upbeat vaccination numbers on a day-to-day basis, things are pointing upwards. And of course, to add fuel to the fire, the inflows in the equity markets from the retail and high net worth investment segment has been pretty solid too. And to add to it, the primary market sentiment has also been very buoyant. So all of this is making for a very heady cocktail. Of course, valuations one can debate, but at the moment, markets are not showing any tendency to crack. Of course, presenting some headache for valuation-oriented investors, especially in the mid-cap and small caps.
Gautam, isn't it also about retail investors? I mean, 4 million new retail investors opening their accounts every single month. We're looking at flows of about $1 billion. I mean, can those flows continue? Can they continue to support the benchmarks?
Yeah, you're right. I mean, see, we have seen record number of demat account openings. The SIP book, which is a monthly investment, regular investment plan of retail investors, has crossed a psychological barrier of 10,000 crores. This used to be 8,000 crore a year back. So clearly there is an upbeat sentiment there. What is also happening is the competitive asset classes, whether it is fixed deposit, real estate or gold, their returns have been very subpar, so to say. So therefore there is a natural tendency to move towards a slightly higher ending asset class. I think we've just scratched the surface on financialization of savings, and this theme is going to remain prevalent for at least a decade. So I'm quite confident that the flow of assets into the equity markets from the retail investors can continue. And now that they've tested blood, I don't think this is going to stop in any meaningful fashion. Of course, there can be some corrections here or there based on how things pan out. But from a slightly longer term point of view, I think this is a big trend that we are betting on. And there are many stocks which can be a direct play on this theme, which is financialization of savings. This has been this has been underway for the last 3-4 years now. It's just that post-pandemic, this is accelerated, and now we are seeing a full blast of that theme.
Gautam, when we look at the whole space there as well, and we look at equities and you look at valuations, I mean, we've got the Nifty on, 29 times forward earnings PE-wise, and that's got to be a concern, as is perhaps inflation, and also how the central bank actually responds to all that and how its stance changes.
Absolutely. See, there are two ways to look at it. So valuations have clearly got re-rated. We are trading at 21 times FY23 earnings now. At the same time, what has also changed is after a decade of stagnation, the earnings cycle, the corporate earnings cycle in India has moved, has turned the corner. FY21, which is the year which has gone by, was 15% earnings growth year, which is the highest in 11 years. In FY22, our expectations is of 34%. And then on top of that, we are expecting about 19%. So India is seeing a corporate earnings revival after almost a decade of stagnation. And as long as you do not see a downward earnings revision in a material manner, markets can continue to surprise you, which is what we've learned from the past cycles. If I take you back to 2004 to 9, at every given point of time, at every milestone, market looked expensive. But earnings kept pouring in, and therefore markets kept making its journey higher and higher from 6,000 Sensex to almost 20,000 Sensex. I'm not trying to predict a forward return of similar magnitude, but all I am saying is the underlying fuel, which basically which basically propels the market forward, is looking very strong. And earnings have never looked so strong in the last 10 or 12 years. So as long as corporate earnings do not disappoint, markets will have very little room to correct. And on the contrary, if there is a disappointment in the earnings, then the room for error is very limited as far as valuations are concerned, whether you look at Nifty or mid-cap or small-cap indices in India. But at the moment, going is very strong as far as earnings are concerned.
Gautam, I want to dial back to what you said about the huge inflow of retail clients. There's an old adage that when the taxi driver starts asking you about stocks, it's time for you to get out. Do you adhere to that?
Yes, I do, but so far I haven't heard those kind of anecdotes yet in India. Right now, see, one of the interesting thing in this cycle so far is, in the earlier cycle when the markets were, in a bullish territory, 2007 to 9 or 2004 to 9, all kinds of stocks were rallying. Good companies, bad companies, everything was rallying. In this cycle, you are not seeing bad companies rallying. Good companies, good stocks are rallying. You can have your issues with valuations, but the underlying business model of the companies which are doing well is very solid. Whether you look at IT companies, consumer discretionary, consumer staples,
right,
metals, or private financials. So there's a difference there. We have not yet reached a stage where, you start, looking at valuations and say it is exorbitant and everybody is asking you about stock tips or giving you stock tips. That sort of a scenario hasn't yet reached in India.
Gautam, very quickly before we let you go, your target for the Sensex year-end. At one time we were looking at 60,000. It's way past 60,000 right now. What's your take? That number.
So the way I look at index targets, we generally do not predict index targets. We believe in bottom-up investing. But it is fair to say that markets from here will be a function of the underlying earnings growth. If in the next 1 year you see 20% earnings growth, the market will give you 20% return. If you do not see earnings growth of more than 15-20%, the market can have a time correction because we have borrowed returns from the future when you talk about the PE rating from 17-18 times to 21-22 times. So all the index targets from here on will be a direct function of what is your underlying corporate earnings growth from here on.
All right, Gautam Duggad, Motilal Oswal Financial Services, we thank you so much for that. 5 minutes into the Indian trading day, it's going.